Hi, my name is Lauren Hughes, and today we'll be talking about measuring risk with IW Finance 315, Week 6. During this presentation, we will cover what are risk measures, how we break it down, and how do they apply in the real professional world at all levels. When it comes to measuring risk measures are statistical measures that are historical predictors of invest risk and volatility. They are also components of MPT, Modern Portfolio Theory. MPT is a standard financial and academic methodology for assessing the performance of a stock or a stock fund as compared to its benchmark index. In order to reduce risk, investors should have diverse portfolios. Market portfolios are all the risky investments held in proportion to their value. On page 903 of Horgan's accounting textbook in our course, suppose all investors had portfolios that contain only systematic risk. In this case, then consider portfolio we've obtained by combining the portfolios of every investor. The text says because each investor's portfolio contains only systematic risk, the same is true for this aggregate portfolio. Market portfolios will generally consist of all risky securities in the market with portfolio weights proportional to their market capitalization. Market capitalization is the total market value of a firm's equity equals the market price per share times the number of shares. When breaking down measuring risk, there are 5 principal risk measures. These include alpha, beta, R-squared, standard deviation, and Sharpe ratio. These can be used individually or together to perform a risk assessment, the ideal way to compare potential investments. Alpha measures risk relative to the market or a selected benchmark index. Beta measures the volatility or systemic risk of a fund in comparison to a market or a selected benchmark. A beta of 1 indicates the fund is expected to move in conjunction with the benchmark. R-squared measures the percentage of an investment's moment that is attributable to the movements in its benchmark index. An R-squared value represents the correlation between the examined investment and its associated benchmark. Standard deviation, a method of measuring data dispersion in regards to the mean value of a data set and provides a measurement regarding an investment's volatility. This measures how much return on an investment is deviating from the expected normal or average returns. And finally, Sharpe ratio measures performance as adjusted by the risk it is associated with, done by removing rate of return on a risk-free investment. An example of this would be a U.S. Treasury bond. Risk applied in the professional world, starting at the entry level, involves, for example, putting money into your 401k. Without putting money into your 401k, you are risking the opportunity of taking advantage of programs to where you can save for your retirement fund. Without putting that money away, you will not have a lot of money set aside for emergencies and being able to retire in the future. At the mid-level, risk is measured in terms of business metrics. Professionals look at the opportunities of how their business is doing and what things they need to adjust in order to make sure that their business is running properly and they're not losing a lot of money and making sure things are running properly. And at the executive level, controlling opportunities of expected losses and gains. What this means is executives already know what they are going to expect from their business based on the stock market. The stock market predicts and shows how people's businesses are doing so they know how to make adjustments in terms of buying or selling. In terms of ethics, social performance is a very important key in terms of measuring risk. Being an ethical leader and having value-based decision making is very important. You must make careful choices on decision making, especially when it comes to making adjustments in terms of money when involving risk. In the Bible, Matthew 25:29 says, "For to everyone who has will more be given, and he will be in abundance. But from the one who has not, even what he has will be taken away." This concludes my presentation on measuring risk for Finance 315. I hope you enjoyed and look forward to week 7.